SD Bullion has just launched Survival Food, headlined by the only 100% organic, GMO-free survival food. Prepare like the doc. Purchase your survival food from SD Bullion today.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, we had a big week early in the week, or early to start 2014 in gold and silver, especially silver, as silver began the new year in Asia, bursting from about the 1940 level up to a peak of about 2050 before pulling down a little bit early on Thursday, but then held on to those gains, plateauing and consolidating those gains throughout Thursday's New York session, and overnight Thursday, and throughout the Asian markets Friday and the U.S. markets Friday as well, kind of with a tight consolidation pattern between $20 and about 20, just over 2020 on the upside Friday. And gold also had a nice move to start 2014, up Thursday and now again here on Friday, actually just peaking just above 1240 on Friday and consolidating down into the 1230s, so up nearly $50 off the lows of the end of 2013. So it'd be interesting to see if they can continue the runs next week, but positive moves for both gold and silver here, Eric, to start 2014 after the beating to end the 2013 calendar year.
Indeed it was, and it's certainly a nice change of affairs after going through all of 2013, seeing guns and old saying that first couple of days of trading in any given year mark the trend that you'll see through the rest of the year. More pertains to stocks and the statistics that have been run over that over the course of the last 100 years or so. But silver and gold are definitely their own markets and their own beasts when it comes to the factors that push them around. But it was encouraging to see, and silver shot up first strongly, as you were noting, and it is interesting to see that it kind of just was going at a measured pace today. And the fact that it wasn't able to be pushed down shows that there's consistent buying. But gold on Friday, when we're recording this show, is definitely stronger than silver. It's also worth pointing out, too, that the mining share equities were a little bit weak. Saw strength certainly earlier when gold and silver shot up on New Year's Day and yesterday. But today the performance wasn't that great. So it's possible that we're basically seeing just an effort to kind of keep a lid on the level of excitement that's going around. And when you look to silver and equities showing that they're underperforming gold, that sometimes is in fact kind of an artifact or a signal that comes when the cartel is active. And they certainly were active earlier when because gold wanted to move a lot higher. You could tell in the initial pressure and short covering and then organic buying coming in. But we still saw the 1% cap and then the 2% cap earlier this week. And that's just, those kind of things don't happen in normal markets. I mean, commodity markets in particular are very volatile. And more than 90% of the time when we have had upside reversal days or just days where there has been ongoing accumulation, the prices in gold never exceed those 1% and 2% caps depending on how powerful the up moves are. And that statistically just proves yet again that there is a cartel, that it is active, but pretty much nobody in the mainstream media ever talks about these things from the statistical probability point of view, because the numbers are just so astronomical in the sense that they just don't happen in normal markets. But anyway, that's an old story. We've talked about that many, many times. Bottom line is that it looks like even with all of the excitement here, the cartel's still active, and it might very well be that they'll try to keep a lid on things on Monday forward next week. The bond market ticked down a little bit in terms of the 10-year yield. The stock market was modestly weak Friday going into the close, and it looks like things are just kind of calming down initially, and we'll see where things go in the later part of next week. But we're more in the mode now, I suspect, for 2014 of the managed retreat for gold and silver from the perspective of the cartel. And that's a phrase that the guys at GATA had coined. I think it was James Turk actually who came up with the phrase first, but basically meaning that the cartel doesn't have the gold to manage gold prices down indefinitely, and that the markets have been pushed down so much that we have to have a reversion to the mean, and that the cartel will let prices move up a little bit higher as we go forward, therefore being in a managed retreat mode on their part. That's what I suspect we'll see through January. But, the organic demand's still there. People are making a big deal about China's imports dropping in November, but we saw that big leap in December where there was the offtake of 57 metric tons on Shanghai's market, and certainly the buying was really strong New Year's Day in China. I mean, everyone knew we're running to places to buy bullion in the main bullion marts with all of the Chinese antis picking up gold with the monies that the Chinese economy has generated from selling the plastic stuff to the United States shoppers who line up in big lines at Black Friday to buy and earn money for China. Goes around, comes around.
I think it was a 10 or 12 hour wait on New Year's Eve for physical gold, and it was totally cleaned out then 3 hours after the store opened.
Yeah. So, bottom line is, the press consistently in the West points about everything that could be made negative and spun in a negative tone, but in reality, the Chinese people are continuing to buy at a rather steady and high rate, and then the central bank is just vacuuming up any gold that it can possibly find without having a massive impact on price, because their best interests are served by being able to buy gold on the cheap for, the years to come. If they were able to do it for another 2 years, they'd love to. And
another 2 years? Yahoo says that gold's going down for another 18 years, Eric.
Yeah.
They came out, I think it was New Year's Day, Yahoo Finance released an interview with David Nelson, who I don't think anybody's ever heard of him, but the softball lead-in said something like, gold is really ugly. It's down 30% year to date. Should we look at gold here or just stay away from it? Or stay the heck away from it? They said something like that. And then this David Nelson says, I can't find any reasons to like gold. You should avoid it. And I think he said it could take, the last bull market took, or the last bear market took 20 years to bottom. You could be even 5, 6, 7, or even a decade early. So get away from it.
We were speculating, I was telling the audience about where the whereabouts of Jon Nadler were, and it suddenly occurred to us that he probably did a body swap with this author, this guy from this unknown capital firm that got a phone call from Yahoo Finance. So, I don't know. Maybe Jon Nadler's in their research department hiding away somewhere. Should put an all-point.
It could be. We haven't heard anything from him since Kitco gave him the boot.
Yeah.
All right. Well, I wanted to give listeners a quick update or rundown of the year's sales on physical supply numbers from the U.S. Mint. Particularly in silver, it was a record-breaking year, as the record was broken early November. And the final numbers that came in, the Silver Eagle sales with the U.S. Mint were 42,675,000 Silver Eagles, and that was up 27% from 2012 totals of 33.7 million, and I think up about 3 million Eagles sold from the previous record set in 2011. I think it was 39 million and change there, and that comes with almost all of December. No sales, with the Mint shutting down. I think it was December 8th or 9th that they shut down this year. One of the lowest December numbers I can remember seeing in a while, with only 1.2 million Silver Eagles sold. Usually December is probably the second or third largest sales number in the year. Usually December is a pretty big sales number after January, one of the biggest sales months in the year. So I'd be looking again for a big January sales number from the U.S. Mint this year, probably somewhere in the neighborhood of 4 to 6 million ounces again, with another 1 to 2 million maybe on the upside, depending on market events and conditions. So I'm looking for another big January sales record there. And then on the gold side, Gold's Eagle sales were also up from 2012. From about 750,000 in 2012 to 856,500 ounces in 2013. And one thing interesting to note with gold, the Eagle sales rather than the Silver Eagles, well, they were up from 2012, still not anywhere near the previous all-time record in the physical U.S. Mint Gold Eagles, and that a little bit might have a little bit to do with the Gold Buffalo sales this year as well. And then really the other big, we'll say physical statistic was the big dishoarding of gold in 2013 from the ETFs, particularly the GLD. But I think going back throughout the majority of the bull market, I can't remember a year where the ETFs disinvested in gold, but they did so to really a big extent here in 2013, Eric.
Yeah, the total, just based on eyeballing a graphic I'm looking at that was published in Wall Street Journal, shows dishoarding 27.9 metric tons. I guess they're referring to GLD only. Point being that the representation of that gold dishoarding accounts for all of the gold accumulation in the past 4 years previous, including 2009, or at least a major portion of 2009. So
we'll have to do that about 7 or 8 years in a row to get Germany anything, or what the Bundesbank is anticipating.
Well, yeah, there's that, and there's also the fact that the majority of that gold that was going out of GLD and other places were, in fact, just flowing to China. So Germany was going to have to take their fifth row seat or something. Who knows? But it's interesting that statistic, and I need to refine this and get more exact numbers than what I'm looking at on the graph here, but the basic point is nonetheless something that can be spoken of, and that's that the dishoarding level that came out of the ETF roughly matches at least the last 4 years of accumulation. And that just kind of speaks to the exhaustion phase that you'd expect in a market, and much to the chagrin of the guy reporting in the Yahoo Finance article, there is very little fat left within these ETF vaults to be able to continue to try to shake the tree and get people to sell out their positions on the COMEX and the LBMA, such that the paper price drops such that JP Morgan and all of the other authorized participants able to make their 100,000 share bundles of the GLD sell to withdraw out of that vault and to take that gold and either store it on their own or sell it to China for a $30 over spot premium or what have you. I mean, they've been doing all of the above, but there's only so much gold left, and at this point, I'd imagine that just to be able to maintain the facade of the ETF's ability to give the impression that it in fact is ongoing concern with the ability to be backed up by gold, there's not a lot of room to shake that tree anymore. So it's yet one more point that suggests that after 2+ years of a pretty strong correction, that we're probably going to see upside in 2014.
And just to put in perspective how close the Western banking cupboards are to being completely bare of gold, it's pretty astonishing the numbers that have been or are being withdrawn from the Shanghai vaults at the Shanghai Gold Exchange. Throughout the month of December, there's been about 50 to 60 tons per week withdrawn from the Shanghai Exchange. I think year to date it's at 2,128 metric tons, and for 2013, and that's still the data lags about 2 or 3 weeks. So I think it was on pace for just about 2,170 tons for 2013, and that roughly is equivalent with Chinese gold demand, pretty roughly, but I mean that's a pretty astonishing number, just the physical gold being withdrawn from the Shanghai vaults.
Yeah, and I'm looking at the GOFO rate numbers right now too, and starting on December 18th, it swung into the negative. It's been negative all the way through to today, believe it or not. Even with the price rise that we've seen in the last couple of days, GOFO is still negative. So it's a very tight market, and we should see upside in the month of January for sure.
So Yahoo's predictions notwithstanding, I'm going to stick to my call a couple of weeks ago that I thought at the time that the metals were likely to bottom in the next 10 days. It's a little early still to make that call for sure, but between the sentiment, as terrible as it was throughout the end of 2013, really, it was bad over the summer in June, July, and August, but November, December, I don't think I've seen worse sentiment among the precious metals investing community at whole. So I'm still going to go out on a limb and say that we're likely to have bottomed here. It'll obviously take some time before we can say that with any firm conviction. I agree with Eric that metals should be going up in 2014. Especially, we really haven't seen any major short squeeze yet. It won't take too much momentum to the upside. Silver probably going back through about 22 or 2250. In my mind, probably gold breaking back through 1350 or 1400, and you could see a rather explosive short covering or short squeeze move to the upside.
Yeah, and keep an eye on the 10-year bond note and its yield. Right now, it's at 2.99 closing basis today. It hit a 3.04 a couple days ago, and I think that as we move into February, we should probably be looking at maybe a 3.2 handle or something like that on the interest rate for the 10-year. And at that point, people are going to begin to reevaluate the question as to what happens when the Fed holds, or presuming that the Fed holds true to their bargain of their tapering of $10 billion per month going forward. That'll have ramifications on the long-term bond market yields and in turn the stock market. We'll have a period in April leading up to April 15th where it's seasonally strong. A lot of people make deposits to their retirement accounts associated with the United States tax cycle, with April 15th being tax day and all that. But it doesn't look very good when it comes to the prospects of the stock market being at its current high valuation and low participation, relatively speaking, from the retail market. It's more, there's definitely a very high element in the stock market that is just hot money that has moved it up higher. And as the backdrop of interest rates change, people are going to change their perspectives on both the bond market and in turn the stock market. So all of that volatility will also probably be good for precious metals, given that they have been the most hated assets for the last 2 years. So it's all setting up to see reversions to the mean on all of these various markets. The bond market in particular is probably the most grotesquely manipulated market out there anywhere. It's just ridiculous how low our interest rates are, given the fact that rates of inflation far exceed what people are being compensated for by owning bonds, and the number of international partners that are recycling their trade surpluses into the United States market is much lower now, and the talk is that, particularly from China, that they're going to invest less going forward as well. So all of these things will be playing out in that first quarter window, and I suspect we'll see quite a bit of turbulence from somewhere, I guess, around maybe March to June in the stock market in that window. And I'm not among those that are looking for the big one when it comes to corrections or new bear markets in the stock market. I think that we will probably go through another period where, after we go through that rocky period I just described, Yellen will be inclined to ease up on the whole commitment to tapering, and that we'll have some kind of a reversal. They may not add a huge amount of tapering, or may not add a huge amount of new purchases of bonds, but they'll do other things that will have a similar impact to the markets. And in particular, I'm forecasting that they're going to make the interest that they pay banks to hold reserves in the Federal Reserve System, they're going to take that away in hopes of increasing the velocity of money. So all those things told will just set up the conditions for yet one more big bubble. And as that inflates, you're talking about latter end of 2014 going into 2015, matching the same time frame that seems to be being signaled by China, that they're going to try to, in the very least, denominate some of their trade in a gold-backed yuan. And that'll be a game changer when that unfolds. And if it's happening at the same time that the Fed has re-liquefied the system once again, maybe not inflating their balance sheet as much by buying credit, but certainly making the system more liquid from the shadow banking point of view by making banks more interested in making loans and expanding the money supply and the velocity of money that way. It's just not going to be a good thing. I mean, we've consistently tried to bail out past declines with more money printing, for lack of a better way of putting it in a single sentence. I mean, there's lots of tools in which they achieve it, but bottom line is that it's always an expansion of credit to try to cover up the mess that was made before by the previous expansion of credit. And it's a feedback loop that just gets worse and worse, and we're going to go through another one of those periods before, who knows, maybe it'll be the last one. We'll see. But that really is the big picture story to look for in 2014, how that kind of possible outcome gets set up with the possible correction and then the response by the Fed after a correction when they begin to freak out. There's never been a new chairperson, got to get used to saying chairperson, coming into the Fed when there hasn't been a period where they've been tested. You know, Alan Greenspan came in 1987, and there was the 1987 stock market crash of some 27 some odd percent in the period of a month. And you know, Bernanke came in, and we were already kind of rocky and setting up for the 2008, 2009 situation, and you know, he was tested with that. So Yellen will probably have her moment of reckoning in the not too distant future. We'll see.
And one other thing before we wrap up here, Eric, I don't know if you saw it today, but Eric Sprott has come out and predicted that 2014 will be the year that both gold and silver set new all-time nominal highs, and silver will finally clear 50 and gold will clear 2,000. And I know a lot of listeners will probably poo-poo that prediction and, oh, well, he didn't see the correction coming in 2013, which is true. But if you go back to 2010, the last bull move, if I recall, I want to say it was October or September of that year, and silver was kind of stuck in a range trade around $18 or $19 an ounce, if I recall. And he came out and said that silver would reach $50 within 6 months, which at the time nobody else was saying that, and it was sounded like a pretty wild or bold claim. And sure enough, just under 6 months later, on what was it, April 1st or 2nd, it reached about 49.73. So I don't want to argue with Eric Sprott. So he's come out and said that 2014 will be the year that silver breaks 50 and gold breaks 2,000. So.
And you know, we should also point out too that the punditry game and the price target game is really not as important as getting the big picture right over the long period of time, and that is really a perfect descriptor of how Eric Sprott operates. And he really, picking the numbers for this year wouldn't bother him at all to be wrong if next year he's proven right, and in fact we're moving higher to 3, 4, 5, and beyond 5,000 gold and silver over 100 and so forth. And as it stands, given all of the long-term fundamentals, that's where we should go. And it's not possible to predict the degree to which the United States government is going to be forceful in managing prices downward. You just can't put a timeline on that because it's an arbitrary decision made by humans in response to market forces, and it doesn't fit to a calendar, and you can't put it on a chart, and you can't, there's just no fundamental way of now analyzing exactly what the guys are thinking as far as dates that they act and so forth, and the degree to which their force would be manifest. Who could have known that on April 12 through April 15 that basically central banks and their bullion partners would be willing to sell 500 metric tons in a span of a few minutes over the course of those couple of trading days, the pocket bursts of selling, right, that anybody looking at it could only conclude was backed by a central bank, because nobody on earth, nobody has, maybe Rothschilds hidden somewhere in their catacombs or something, but nobody has 500 metric tons of gold to be able to make that kind of a trade. I mean, obviously a big portion of it was naked short selling and whatnot, but theoretically you have to had the wink and the nod from the regulators and the governments to be able to do something like that given the magnitude of it.
And again, fundamentals have not changed. If anything, there's numerous new fundamentals that we didn't have at the start of the bull market. I mean, if you go back to 280 gold a little over a decade ago, there was no thought, or you would have been thought to be insane if you came out and said that the West, the U.S., Canada, and Europe would consider like a 10% wealth tax. And now we have like the IMF and the BIS openly discussing the need for a 10% tax on all bank accounts across Europe. So, I mean, that's just one anecdotal point, but the actual fundamentals for gold and silver, in my mind, are stronger than ever. So,
yeah, and we mine 2,600 metric tons of gold annually, give or take. On an annual basis, it hasn't changed massively. In fact, it's probably going to go down next year by at least 10%, given the price action and the fact that mines have been closed. Meanwhile, we have a consistent demand side consumption of gold of easily over 3,000 metric tons next year, given the trends that we've seen so far, even with, periodic declines in the United States and wiggle months in November, for example, where China buys less. I mean, can't go on that direction forever. If the world is consuming more gold than is being produced, we've already seen indications of above-ground hoards being raided to the point where associated business models like running an ETF become jeopardized and possibly not even feasible going forward, given how much their hoard has disappeared. It's just a matter of time. So getting back to that Eric Sprott call, it doesn't take a lot of difference in terms of the mismatch between 2,600 versus 3,000 plus to force prices higher, and at some point that's going to happen, easily taking out old highs. And whether or not that happens in 2014 really doesn't matter. The bottom line is that it's going to happen within the next 24 months. I think that kind of a forecast has a probability of better than 90%. and on the risk-reward perspective as well, from the flip side, is that there really isn't that much downside, given, again, the fact that this demand continues. Bottom line for 2014, I think.
I'd agree with you, Eric. Bottom line for 2014, the gold and silver demand continues, and the fundamentals start to kick back in. So I think we'll wrap things up there. So for this week, thanks again for tuning in to the Doc and Eric Dubin for the SD Weekly Metals and Markets Wrap.
SD Bullion.